Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of November the 18th, 2024. Now, to get started this week, we'll begin where we always do with that very important US dollar index. What we can assess, or what I can assess here, is the true performance we always measure from the beginning of each new month, each new week, each new quarter, each new year, so we get an accurate measurement of performance. The dollar is up 3.06% in just 10 days. Now, the election, for the most part, is done now. The fundamental picture on the dollar has changed to some degree. I think most of us had some idea who was going to win the election, but the House and the Senate is the wild card here. So now the new administration will have full congressional support in anything they're doing, and that could change the outlook of the directional outlook of the US dollar index and the US dollar in general. So when I look at this now, we have significant headwinds between 106 and 107. But we could move higher than that. We look here now for any type of contrarian indicator in the VP software that would tell us, okay, this move is a little overextended. We're going to have a corrective move back to our T-cross long, that area coming in at 105. Now, the tool in VP that I see producing somewhat of a corrective sell signal at this time is the MA diff cross. As we can assess here, the predicted RSI has been in overbought territory for an extended period of time. But the MA diff cross, what it tells us is that the medium-term trend is weakening against the longer-term uptrend, and that's that pink line crossing over the blue line. Now, any move lower would be, in my respectful opinion, corrective in nature at this particular time, because again, the fundamental picture is not what all of us anticipated. I personally did not think that the Republicans would take that, both the House and the Senate, but they have. So again, anything that's going to get done, well, it'll be a very interesting to see how things progress. So again, the further we move away from the VPT cross long, currently at 105, the more likely it is we're going to retrace to it. A secondary level, if we click on our F8 in our VP software, we have our long predicted. That's at 106.08. So the immediate support to begin the week, because again, guys, always remember, this is an outlook, not a recap of something that's already happened here. So 106 is the first level to test to see if we can break down. And again, looking at that contrarian signal with the MA diff cross, a corrective move is entirely likely, but again, a very positive outlook right now for the US economy. Now, when we measure that directly against gold, you can see that gold is down 6.61%, still firmly above its yearly opening price at 2066. And I would argue 90% of the time, guys, gold goes up in the month of December. So I would not count gold out just yet. So again, another contrarian buy signal here, the MA diff cross. We've been sitting in, again, this is why we have to be very, very cautious when we talk about overbought and oversold. The predicted RSI has been oversold since the market started moving. But again, as you can see this breakdown, using the current monthly opening price, you can see 4 days in a row, we're hitting into that monthly opening price at 27.43. We come down, retrace back to it, and then the real move shows itself. But to be clear, guys, gold is still bullish while above 2066. We're still positive on the calendar year. We need to get further information from the Fed, but I believe he will, or I did believe he would have to cut considerably in 2025. But now you could have, with some of the new policies coming in, you could have inflationary pressures, which again, could support a higher dollar. So we do need to be cautious here. But in the month of December, usually that is when gold makes its move on a weaker dollar. But this year, I will concede, could be very different now that the election, for the most part, is completely finished, with the Republicans making a clean sweep of just about everything. Now, when we look at the S&P 500 for, again, the true performance on the month here, guys, we can't shift the where we pick our performance measurement from random days. We want to know exactly what is going on in the month of November. So we've been up 5%. We've retraced back to the T-cross long. We don't quite yet have a crossover on the medium term crossover. The long term is quite a ways from that, but again, showing you the power of that MA diff cross when you combine it with a verified resistance zone. That area high at 60.17. Now, in this particular environment, it is entirely possible that the equities and the dollar can go up at the same time as money moves into the US, the bond markets, everything else. So again, I'll monitor this over the next several months, but for now, pressure is building on the downside, but I believe the stock markets will recover on this despite a stronger dollar. The T-cross long, 58.82, that's the area to keep your eye on. If we can get back above that by Tuesday and hold above that, it will confirm the short or medium term contrarian sell signal on that US dollar index. And then we may see some gold come to life to some degree. Now again, that monthly opening price of 57.23, very important. When we look at the performance of light sweet crude oil, down 5% on the month, so that inverse correlation between the dollar and oil. Again, if the economy is as strong as what they're trying to tell us that it is in the US, then you would think oil prices would be turning around here soon. So that there is a possibility of that, but we are below 71.78. The current calendar yearly opening price, as long as we're holding below that, oil remains bearish. So again, most of the indicators are saying there's more downside, but watch the two verified support lows. We have seen some buying there. The first low 66.64, and then the big one over here at 65.99 if you're an oil buyer. Watch that area, but always look for a contrarian signal from one of the predictive VP indicators before you necessarily jump on that. Now, once again, the top performer indisputably here is Bitcoin again, as I've discussed since on these webinars since the end of August, beginning of September, that there are known patterns with Bitcoin in October and November. So we've made a big push up, 34.09% on the month here. Now we have a newly formed verified resistance high, 93,331. So once again, the question will be, can we break through that? And we very, very quickly this past week took out that 80 and 90,000 mark. Can we get above that psychological 100,000 mark? Well, the MA diff cross here is suggesting that we're going to have a corrective move first. Now, once again, we use those predicted moving averages as pivot levels. Our T-cross long, 80,674. If we click on our F8 in the software, you can see how the market is in constant contact with this blue line. We don't need to wait for a crossover here, guys. We can use the predicted moving average by itself and pick up longs or shorts on that area. So that particular immediate support level would come in at 88,259. I will respectfully submit that if we can hold above that level, then the 100,000 mark or a break of that level is still within reach. So again, you're going to get some traders caught long, some traders get caught short, but the pattern, the 3-year pattern in Bitcoin remains fully intact, meaning that next year is likely to be a very strong up year also. Then 2026, we start to run into problems, or a naturally occurring substantial corrective move where Bitcoin could be down 20, 30, 40%. But in the current environment, there's a stronger argument for a clean break of the 100,000 mark. Now, when we look at the VIX here, the VIX continues. You can see once again, guys, this is the benefit of understanding proper anchor points. We don't want to measure performance on the VIX using a random 30 days, 60 days, 90 days. We want to know where are we on the year. The VIX is bouncing off this area, and we've had a fairly substantial rally on the VIX on Friday. So once again, when they're telling you the VIX is bearish, in actual fact, it's not. When we look at the MA diff cross and we combine that with the current calendar yearly opening price at 1501, we have a very, very good structure in the market, and we ignore conventional tools and say, well, they're saying it's bearish, but how could that be? If I bought it on January 1st, this is still profitable. So if it's truly bearish, we'll have a complete breakdown below the current yearly opening price, and that will tell us that the market is bullish on stocks and bearish on the VIX. They are not saying that right now. So again, we'll continue to monitor this, but that MA diff cross is very important to watch because that will get you into a trade very quickly, okay? So again, once if we look at that with a conventional blue line crossing the black line, it's a great trade down. And you can see we had an MA diff cross here too that was several days before that crossover took place. Right now, the blue line has not crossed the black line, but the neural index strength, the MA diff, we've got rising momentum to the upside. So that tells us we've got a little bit more downside on the stock market before we figure out if we want to stay in the long on the equities. But if the U.S. economy is booming like they're telling us it is, then stocks should be the place to be. Now, when we look at the longer term structure here, the euro under pressure yet again, guys, and this is all about interest rates, the economy, the Fed, the new administration, tariffs. There's a lot going on in this Forex pair. So in this particular week, I would take us back a little bit further so we can see the structural bias of this particular market. The euro has been holding above these lows, and they're coming in around 104.49. That's the area we got to be careful of, guys. Now, if we lose this particular area here, then basically this longer term 2-year channel we've been running in between approximately 104.56 and 112.40. If this breaks, then you could see the euro move towards parity or even below. But if it holds, then we look to go back towards our T-cross long from a corrective standpoint. But whenever you're doing a short-term trade, guys, or even a medium-term trade, we've got to look at the long-term structural bias. I would have a heavy bias, or I previously would have a pretty heavy bias against the US dollar based on the fundamentals, but that didn't play out the way any of us thought it would with a clean sweep of the House, the Senate, and the US presidency. So again, I need to see some of these policies before we go all in on the dollar, but for now, the market believes that this is going to be a good thing. So 104.56 will likely come into play next week, or it's very possible. So when we look at the long-term structure, then we come in and look at what is occurring now. So once again, I do see an MA diff cross. This tells me we have a corrective move higher on the euro, but that's all it would be, guys. When we look at there's your quarterly opening at 111.35, 110.38 on the yearly opening price, the monthly at 108.84. And then we even use the weekly opening, but you can see that this is a very accurate market structure, and this is when you move to a rolling performance, or you pick a random 5 days, a random 30 days, it causes price distortion. That's all it does in most cases, where this is very clear what's going on here. Now, that was the election bar that I had talked about last week and the week before in the Outlook, and I had stated that, well, watch for a break of either the low of the election bar or the high of the election bar. So obviously, with everything that has occurred, the break was on the lower side of the election bar. So be cautious down here of a potential short-term bear trap between 104.50 and 105. That's the area you got to be careful of. That's all I'm saying, because there are warning signs in the VP software that there could be a problem. Now, when we look at the U.S. Swiss franc, once again, the U.S. Swiss franc is an interesting pair because it also counts as a safe haven currency. So when I'm looking at it now, I've got a push up and then maybe a little bit of profit taking on Friday. That's entirely possible. So the high there is 89.18. Even if the dollar is very, very strong, it's possible the Swiss franc can be also. So right now, once again, another MA diff cross to the downside. The predicted RSI, heavily overbought territory. But again, we need tools like the MA diff cross that are contrarian, that are telling us, look, the market's going up, but something internally based on the correlation to 31 other markets are not. So that doesn't mean that it will absolutely go lower, but a corrective move. Pick your corrective points, guys. T-cross long, 87.49. Click on your F8. and you have your long predicted. That's coming in at 88.39. We know if you're going to buy, then you want to buy between these two levels. Now, I will say for Monday, the predicted low here is at 88.49. The long predicted is 88.39. So that connects the dots to a predicted moving average and the predicted high and low of the day. There isn't a significant gap between those. So it simplifies the entry process and say, okay, I think I can put it right in there, and then I can have my stop outside or underneath the T-cross long. Or I can buy between the long predicted and the T-cross long. But it gives us that area with a warning sign with the MA diff cross suggesting, yes, we are going to likely come lower. I suspect if that does come lower, it's not going to be Monday. It'll be Monday after 10 a.m. or it will be Tuesday, Wednesday. Now, the pound dollar, the data coming out of the pound dollar, obviously that fundamental is affecting the British pound, but the break of the yearly opening price, guys, 127.31. All eyes now should be on that particular level. If we remain below 27.31, then we are likely going lower on this pair. But again, December is not a favorable month in most cases for the dollar, but this could be different this year, as what I've already discussed. So we'll watch it, but either way, if you're a cable or a British pound bull, then I would recommend just putting buy limit orders above 127.31 and wait for it to come back, cross back over that area, so you're not getting caught in a bear trap down here. But again, if that MA diff cross is trying to produce a contrarian buy signal, and our retracement point, which has absolutely nothing to do with conventional Fibonacci or anything like that, is our long predicted 128.70. And again, click on your F8. And then you can get your additional level. Now, this one is particularly interesting to me because the long predicted is sitting right on the current calendar yearly opening price. And again, we don't want to measure performance from random points. If I went back 2 years or 6 months, I want to know where I am in the calendar year, because as I've talked about many times in these presentations, that at this time of year, many markets come back to retest where they began the year. And that's the most simplistic way to put this is if you bought or sold the British pound US dollar on January 1st of this year, you're up a little bit or down a little bit. But these moves in between have been very significant. And I can assure you there will be a significant move from this particular level, either to the downside or the upside. But for it to be to the downside, we must hold below 127.35. And if we're going to buy this thing, we should be buying it above 127.35, or until unless we get a contrarian signal sooner. Now, with the Japanese yen, once again, this could trigger a potential carry trade again. We've talked about this in the VP live room. I would caution everybody with the Bank of Japan that they could be getting ready to intervene somehow, because I'm sure they know what I know, and the potential for a dollar rally is very strong. So if that's the case, it would reignite that carry trade, which they don't want. So be careful with this particular pair. The monthly opening price here, I believe to be a big one. That's coming in at 152. We've got our T-cross long, 153.17. Longs carry a very slight edge, but the fundamental of what the Bank of Japan is going to do here, be very, very cautious. Now, the US-Canadian pair, once again, failing to some degree on Friday and pulling back down, closing at 139.34. Once again, very interesting that we had that move lower, but in 2025, I believe in the mid 2025, buying Canadian dollars should be a pretty good play. Just got to see where we go with these tariffs, but I believe there will be there's going to be an election sooner rather than later in Canada. And I think that Canada will go down a very similar path as the US is going. So if that's the case, that would be positive for the Canadian dollar. So the Bank of Canada is still a wild card, But for now, our T-cross long 139.11. We don't have a strong contrarian signal here to sell this yet. So my view would be, if we break down below the monthly opening, we break down below the T-cross long, then we potentially have a trade here, guys. So we'll see where we go with this one. But the main thing is know your levels. 139.11, longs are favored. Below 139.11, a much deeper move down, probably towards the quarterly opening at 135.26. We always want to have those price targets, guys. And using current levels is very, very important. Now, the Aussie US and the Kiwi, a very similar trade to the Canadian dollar trade. We are going to need the equities moving higher. Some of your metals, we need a more of a risk-on environment to get the Aussie moving again. But for now, as you can see, the structural bias over a 2-year period is going to look very similar to the Euro-US pair. So right now you can see this longer-term channel. Is it possible we could get back down to 63? Well, it is possible. But I think for now, the immediate verified low is coming at 64.73. So keep an eye on that area next week. If the dollar stumbles a bit, or if there's a corrective move on the dollar, profit taking, then that would send this back up on a shorter term basis, maybe for a couple of weeks. But we shall see. So right now, again, we look for any kind of contrarian signal. We don't have it right now. The MA diff cross was deadly accurate yet again as it got all tangled up in the T-cross long. Now again, using a single predicted moving average, it removes any kind of lag out of the market. It basically allows us to see how the market is reacting to that predicted moving average and the correlation to 31 other markets. That's the whole concept behind this, guys, right? So I often have a 2-day rule. It's got to close above the T-cross long 2 days in a row in order for me to say, okay, we've got a trend. But I also want to be able to identify the primary trend using the quarterly opening and the yearly opening and even the monthly opening. And this trend is down. There is no question about it. So that single close above here, the very next day, we're closing right back down again. But understanding the structure of this, it can be very, very helpful to new and old traders alike. It's never too old to learn something different and apply it, because again, we always want to stay current. If you're looking at, every month we have new CPI, new PPI, new Fed, a new Bank of Australia. We have all these things that occur every 30 days. They reoccur every quarter. They actually reoccur every year. So we want to know where we are in that. And you have banking transactions that occur in November that don't occur in October. That's why isolating the month is extremely helpful. Now, the Kiwi, we're going to see something very similar here. Once again, can we move higher on this particular pair? There looks like there is something trying to form here. But if the dollar remains king, it's going to put pressure on, and more specifically, if the equity markets like the S&P 500, the Dow, if these global equity markets don't rebound higher, then the Aussie will not rebound higher either, nor will the Kiwi. So the docket's relatively light next week, but I think you're still going to have volatility until we know exactly what some of the new policies are. So with that said, this is the Vantage Point AI Market Outlook for the week of November the 18th, 2024.